Welcome to our presentation of Catapult's FY21 results. As we have done in previous presentations during this COVID-impacted period, we are sharing this recorded video presentation as travel has been limited due to the pandemic. I am joined today by Hayden Stockdale, Catapult's CFO, who will also discuss key parts of our results. But before we dive into the numbers, I want to point out that all FY21 results in this presentation refer to the 12-month period that ended March 31st, 2021. I would also like to thank Catapult's global employee force. Despite the circumstances the pandemic presented this fiscal year, our staff stayed focused in helping and supporting our customers. They worked extraordinarily hard during this year, and these positive results are a testament of their great efforts. I would first like to kick off by sharing how growth momentum is shifting. I will share more specifics during this presentation, but the headline is that Catapult is seeing significant growth in its SaaS metric, and that has continued to accelerate as we exit FY21. These metrics are a leading indicator of future revenue, and we're very pleased with the trajectory that we see. Our key leading indicator, ACV, that is annualized contracted revenue, grew 35% on an annualized basis in the second half. That means Q3 and Q4. The impact of this growth momentum in ACV is already having a positive impact in our recognized subscription revenue. Q4 subscription revenue grew 12.5% against the previous corresponding period, which was non-COVID impacted, versus a full year rate of 3.3%. And in Q4, our subscription revenue was 87% of total revenue, up from 83% in Q4 of FY20. As we have successfully continued to switch to higher quality recurring revenue away from one-time capital deal, this number is very pleasing to us. Before I break further these numbers, it is important to remember what Catapult was facing at the start of FY21 and why these results are even more stellar in that context. The last 12 months was the most difficult period in the sports industry since World War II. There was a global shutdown of major sporting events, delays in return to play, and games without live fans. This impacted our customers significantly, creating major revenue losses for the industry during the year. H1 was significantly impacted. The uncertainty of the future that many of our customers faced created significant hurdles in our potential to drive new sales. And while we began to see positive signs in the second half, seeing events such as the NCAA March Madness return, along with some return of fans in stadium across the globe, we were unsure how it would impact us during this half. Navigating this turbulent period, it was important to me that Catapult stayed focused on its long-term strategy. We prioritize retention. We prioritize continued shifting up to high-margin subscription sales, increasing the adoption of multi-solution customers within our customer base, and generating cash. And I know that success through this period would only improve our position for future growth. And this focus not only allowed us to prepare the company for a better future, but it allowed us to capture this shift in momentum in a significant way. As mentioned, our annualized ACV in H2 grew 35% on an annualized basis. But even more impressive was the growth that we've seen in our performance and health category. Our P&H vertical saw an ACV growth that was nearly 3 times compared to FY20, a non-COVID impacted year. In Q4 alone, momentum really shifted. Our annualized ACV growth was 55% in this category, with all regions growing above 40% on an annualized basis. We also saw this momentum in our ACV churn, with the second half churn being at 5.5% versus 6.8% in the first half. And in H2, our multi-solution customers base grew by 40%, another sign of a great shift. Our confidence in our strategy was further enhanced by our ability to improve our cash position for a second consecutive year with positive and growing free cash flow, showing the capability we have to generate long-term cash. Moving on to slide 6, we can see more detail of our SaaS metrics. As we continue to focus on our core SaaS metrics, they delivered stellar results in FY21. Our 2 key SaaS growth metrics deliver well above expectations. ACV growth was up 16.5% during this very challenging year. And a key thing to note here is that our global footprint allowed us to deliver growth even when one region was challenged. We see this as a significant growth opportunity as the impact of COVID lessens in that region. And we actually have started to see some of that rebound, which I'll explain in a minute. ACV churn is down 5.5% compared to last year's number of 6.4%, showing a 14.1% improvement. We're also pleased with the quality and the efficiency SaaS metrics that we set out for ourselves. Multi-solution customers grew 17%. Contribution margin increased to 48% as we continue to improve the cost it takes to service and generate new sales. While the average lifetime duration moved down slightly, we are pleased that it was driven by growth versus churn. Overall, what we are seeing is a strong return to growth in our SaaS metrics, and as the impact of the pandemic lessens, we expect this trajectory to only continue. From a financial output perspective, we delivered a positive free cash flow of $4.9 million, up 69% from last year. Subscription revenue was up 3% for the year, but we saw a strong subscription revenue growth of 16% in our performance and health vertical, our largest solution by revenue. And recognized revenue and EBITDA are down compared to last year, as we have continued to successfully switch away from capital sales to higher margin SaaS deals and the COVID impact in our licensing business. However, since these are lagging metrics, I want to focus on the leading metrics that are making us very excited about the growth momentum we are seeing. If we look at our ACV growth in the last 4 quarters, you can see that how momentum shifted in the last 2. Each Q3 and Q4 delivered an annualized growth rate of 35%, the type of growth rate that is typical of a high growth SaaS business. And as we move into slide 10, you can see how ACV grew by region. The growth rate in EMEA and APAC was stellar, while the impact of COVID in the Americas, especially due to the NCAA, delivered only 4% in FY21. However, this crystallizes the tremendous potential Catapult has looking ahead as COVID impact lessens in the US and Latin America. And in Q4, we already saw this growth rate rebound in our performance and health category. In slide 11, you can see our ACV in the second half is starting to outperform our CAGR. However, what this slide really highlights is the strength that Catapult has in expanding its ACV as our customer life increases. While we saw a reduction in the 2 to 9 and 10 plus year category, they were due to lapse renewal from the COVID impact. Those lapse renewals were recaptured, but they are now classified in the under 2 year category. If we normalize this, what we would see is an increase in ACV across all 3 categories. Expanding ACV with long-term customers is key to our strategy, and this trend bodes very well for our long-term strategy. Another sign of great momentum can be seen in the growth of subscription revenue. In FY21, our subscription revenue represented 79% of our total revenue, a 12% growth reflecting a positive trend of our strategy in growing higher margin revenue. But moving into slide 13, you can see how the subscription revenue accelerated through the year as a percentage of total revenue, as we prioritize recurring revenue over one-time sales. And in Q4, we saw subscription revenue grow 12.5% overall. Moving into slide 14, you can see how we are replacing capital revenue with subscription revenue. The acceleration of the orange bar in Q4 is significant, and we feel positive of the speed and success we are having in driving new subscription sales. Another positive momentum was the acceleration we saw with multi-solution customers in the second half. While multi-solution customers was up 17% in FY21, the annualized growth in the second half was 41%. We continue to remain bullish on the upside that remains with multi-solutions growth. Slide 16 is the most powerful slide in expressing the quality of our products and our service. ACV churn has continued to stay at world-class levels, and in FY21 dropped to 5.5% for the year. This result would be stellar in the best of years, but it is truly significant considering the challenges that COVID presented to Catapult in FY21. On the next slide, you could see that not only we have been able to recapture growth and keep churn low, but we continue to do so efficiently. Our gross margin continued to rise, and in FY21 was 74%. While we are happy with this number, we do see this as an opportunity we would like to improve. However, our contribution margin fared extremely well in FY21 at 48%. We do anticipate some contribution margin pressures in the short term as we transition away from capital sales to subscription sales, but we expect this to pay off as gross margins should improve during the shift. Now I'd like to discuss a little bit more about the Pro segment in our business. Our Pro segment ACV had a very strong growth within our performance and health vertical. While our other verticals did not see the same level of growth, we were very pleased to see how stable it was during this pandemic period. I'm going to cover our two largest verticals in our Pro segment, and we could see some great positive trends happening in both. In slide 19, you can see that the trend of our performance and health vertical, what we saw was ACV grow almost 3 times faster in FY21 than FY20. Performance and health is an early cycle solution, and we are pleased to see how quickly the momentum has returned. More impressive is this trend in the chart on the right, where you can see ACV growth in Q4 was up 55% on an annualized basis, with all regions, including the Americas, up more than 40% on the same annualized basis. Moving to slide 20, you can see the trends that we have on our tactics and coaching solution. ACV was marginally down 1% with the impact of COVID in the US, driven by NCAA sports. We have 2 core solutions in this vertical. Thunder, which is in our established higher ACV solution, where our penetration is very high within our TAM, and Vision, our nascent solution with lower ACV, where growth potential is very high. What excited us during the second half was the growth rate of new customers into our Vision solution. We expanded this base by 42% with a product that has a terrific unit economic. Our strategy has been to land and then expand, with expansion coming from ACV growth driven by technology development that is meaningful for our customers. And what excites me most is that in this category, we have been particularly successful in driving cross-sell with our existing performance and health customers, which I just provided in the previous slide, how well it's growing in the second half. Our focus in expanding ACV through technology should only open up great long-term opportunity for our TNC vertical. In slide 21, I would like to share how our reset of our prosumer business has gone. In a very difficult environment, we have been able to keep our prosumer revenue well above $3 million, while lowering our costs to acquire by 90% and improving our EBITDA by 79%. We will continue to refine our unit economics before providing a future growth strategy. However, this major improvement in our business, in part of our business that can deliver another upside to growth, is stellar. In slide 22, I like to highlight some of the key operational wins for Catapult. We had some key sales wins, including expanding our multi-solution customers with major teams, signing new deals with the US Army, and delivering a contract that supported the top 130 teams in the NCAA American football. Our tech also had some fantastic highlights, including a number of COVID solutions, supporting the American football season with new products, expanding our analytics firepower, and the continued expansion of our platform and R&D. I also want to share the progress we've made in taking Catapult to the next level of its SaaS journey. We are delivering what we said we would do. We have improved the transparency of our SaaS metrics, improved our governance and executive capabilities. We've reset our consumer business, and we've began now to accelerate our subscription growth. We still have lots of work ahead of us, but despite the pandemic detour, we're on the right track and delivering. Now I want to hand it over to Hayden to dive further into our P&L.
Well, thanks, Will, and a big hello and welcome to everyone. And just a reminder to everyone that the numbers we're discussing today in this investor presentation are for the 12-month period ending 31 March 2021. These are based on the audited 9-month numbers to that date, plus the management accounts for the preceding 3 months, being April to June 2020, when the pandemic really began to hit. As Will pointed out, we've had a fantastic finish to the FY21 financial year with excellent momentum in our ACV, structurally low churn, and a continued improvement in the quality of our operations, including a quantum shift in our revenue from capital to subscription. These are all great things, but some of it has come at a cost in the short term, and that includes the revenue that we recognise as earned in the year, which has reduced by 7.4%, around 2/3 due to the early impacts of COVID, and 1/3 due to the more recent decision to discontinue wearable capital deals in favour of higher quality, longer term subscriptions. Now, one of the benefits of having a 9-month year is that we can look to just those 9 months, and when we do it, it's clear that the negative revenue impact was concentrated in the COVID-affected months of April to June 2020. In the 9 months since then, revenue is only down 0.7%, and in fact would have been 1.8% up without the discontinuance in wearable capital deals. As we look further down the P&L, we made some great efficiency gains with lower travel and marketing costs and lower COGS for a couple of reasons listed there, all resulting in improved gross and contribution margins. At the fixed cost line, we see the result of our increased investment in growth preparations and a $2.3 million increase in staffing costs, mostly associated with our product, tech and corporate teams. We think this is money well spent, and we'll continue to invest in these areas where we find sustainable long-term value creation opportunities. That said, we are also paring costs where appropriate, and we have managed to contain overall cost increases to $800,000, despite the significant ramping up of longer-term investment. The last item I want to note on this page is the momentum Will has spoken of thematically today, and specifically in the March quarter just gone, the 7% increase in revenue we've delivered on the previous March quarter. So even with COVID headwinds continuing to impact us today that didn't exist in the previous March quarter, even with the dampening effects of switching capital deals to subscription, and even with the lag effects of ACV converting into recognised revenue, we still managed to show some solid revenue growth, and importantly, revenue growth that's strengthening and accelerating. On the next slide, you'll see that this momentum plays out across all our verticals. If you went back and had a look at the same slide from the first half of the year, you'll see that the subscription revenue growth rates across all solutions has improved. The most significant are performance and health subscription revenues, which are growing more strongly off a larger base driven particularly by EMEA and APAC. And for performance and health subscription revenues, it's also worth noting that every single region has shown growth in every single quarter for FY21. Growth in tactics and coaching subscription revenues were more muted given the dominance of the Americas in that revenue stream and the difficulties they faced, in particular with the NCAA. Our smaller verticals did suffer declines, in both cases due to the non-recurrence of one-off items in the previous year. The shift of our revenue is broken down in more detail on the next slide. Consistent with recent patterns, as well as our drive towards recurring revenue, you'll see a reduction in capital and one-time subscription revenues, but growth where we want to see it, and that's in higher quality recurring subscriptions. This was concentrated particularly in the performance and health vertical, with its 15.6% increase in total subscription revenue. On the next slide, we show a detailed bridge for our EBITDA and the flow-through effect on earnings from the lower recognised revenue. Other than movement in the various revenue items, the net increase in costs was around $1 million, with the majority recorded after underlying EBITDA and relating to employee share-based expenses and severance costs. Turning now to the next slide and our cash flow. You'll see here our strengthening in free cash flow is driven primarily through disciplined operating practices, in particular around working capital management and switching a portion of our R&D staff costs from cash to equity. One little factoid worth noting here is that we've collected more in cash from customers in the last 12 months than we did in the previous 12 months, despite the loss of capital deals and our key selling season in May to August last year. So we're running efficiently and cash is very strong. On the next slide, we give a breakdown of the capital investment we've made, which has stayed relatively flat at around 10% of revenue for the year. We've centred the bulk of this into our core Pro segment, focused on our key solutions while moderating our investment for the time being in prosumer. And with that, I'll hand back to Will to close out. Thank you.
Thank you, Hayden. I think this has been a fantastic year for Catapult. We are well positioned to continue to expand our ACV. We have a large and growing customer base. Our data continues to expand and is unrivaled in our industry. And our products are deeply entrenched in helping our customers achieve their best. It is also important to remember that our clients are the very best in their field. We work with the top teams in American football, rugby, European soccer, national federations, and top universities across more than 20 sports around the world. Our advantage only continues to grow in our ability to deliver more solutions to our customers. To recap our FY21, growth momentum has returned. We were able to elevate our key SaaS metrics at stellar levels. We proved our ability to generate long-term cash, and we elevated the capability of the company. It's been a year like no other for sports, and Catapult at the end continues to be a true leader of technology in this industry. I'd like to make a few points in terms of outlook. In the short to medium term, we are increasingly confident in the potential for strong organic ACV growth. We continue to stay very confident in our long-term strategy of expanding our ACV at really high rates. We will continue to focus our transition away from capital deals to subscriptions, and the short-term negative impact will be offset by the long-term returns. And as our confidence in growth increases, we will sharpen our focus on accelerating opportunities that we are uniquely positioned to capture, and we will continue our disciplined approach in applying the SaaS Rule of 40 to our core philosophy in investing for growth. I want to thank you for watching this presentation, and I look forward to speaking to you all during our conference call later on.